Hi, this is Randy Finney with the Right Side of the Chart, and this is a midday market update for Monday, October 22nd, 2018. I won't spend a lot of time on the long-term charts, weekly and daily charts. Just a quick synopsis here for those of you that haven't followed my analysis recently. What we're watching is QQQ, which to me is really, although it's not as diversified as the S&P 500, it has been the leading index for years now. It's concentrated in the beloved FAANG stocks, Facebook, Amazon, Alphabet, Microsoft, and those are the stocks that have actually lifted, done most of the heavy lifting, especially in recent months. And that's another thing that's usually a signature of a market top, whether it's the market top or before a big correction, you see market breadth deteriorate. Things I've covered in the past months, where fewer and fewer stocks are moving up. Fewer and fewer stocks are trading above their key 50 or 200-day moving averages. Those are some of the charts that I've shared. And so what happens is, at the end, those big names that the money is being concentrated into, like Apple, Amazon, Microsoft, Alphabet, they tend to finally just collapse under their own weight. Technical analysis takes over. So there it is. There's QQQ. We zoom in tight. Once again, we are flirting with this long-term multi-year uptrend line and poised precariously above the 40-week EMA. So it hasn't gone yet. And as I always say, support is support until unless broken. So that's it. Now let's talk more about really this week. So the potential is there, and we could either finish the week above those key levels again, or we can break down any day now. And what you want to watch for is a weekly close. But let's zoom down to the intraday charts, because right now that's really all we can watch. This really can anything can happen, can and will happen this week. And that's what I wanted to do this video. And I've said it recently, and I cannot impress how important this is. Today, this week, my expectation is for a lot of volatility, and so far we've seen that today. We've seen some tremendous swings in the market. This is QQQ on a 1-minute chart. Here's where we opened today, right here. So far, we had a swoon down after the open. After first of all, we gapped up. Let me just start there. And if you haven't been in the trading room today, I've highlighted all this throughout the day. We gapped up from right here. There was Friday's close on that yellow dotted line. We were up about almost a percent, faded all that rally and then some this morning. We came down to some key support levels, which I'm going to get to in a second. I want to show you the levels I'm watching. That support held. You can almost see it here on this 1-minute chart. It's really defined the low end of this trading range right here. We'll put that line right there. And so support held, but again, that's a big intraday swing, 1%. And then from there, they turned it around off the lows and ripped it. Actually, let's just look at this HFT, high frequency trading driven rip. 1.5%. You want to see something more impressive? I posted this in the trading room today because I have a mosaic of dozens of streaming charts up at any one time. This is Amazon, the world's second largest publicly traded company, right behind Apple. Almost a $1 trillion company, about a 900 billion market cap. And this stock, in under 21 minutes, ripped 2.56%, 2.5% rip. I did the math on it, assuming round it off to 900 billion market cap. That's over $23 million of wealth created in just 20 minutes from this rip. And you can tell by the look of that rip. Look at the slope. This is high frequency trading. This is computerized algo trading. You don't see the erratic back and forth drops. You see a persistent steady bid up and a ramp, again, a 2.5% ramp in 20 minutes. That's pretty impressive. So it just shows you the machines are here duking it out. There's a lot of algos, algorithmic programs firing off. But what I'm looking at too is, and my thoughts are this, I'm watching this week. I can tell you the takeaway from this video is if you try to actively trade this market, unless you're really adept, and I'll give you the levels to trade off of. I think there are trading ops to be made, but you'll probably get chopped to pieces if you don't know what you're doing. So if you're a swing trader, and I go over the longer term charts, the dailies, the weeklies, even the 60 minutes. If nothing has changed there significantly, and I'll let you know if and when it has, then no reason to second guess your trading plan, whether you're long or short. I'll give you the levels. We're still above some key support levels, although the technical outlook, in my opinion, is still bearish. I'm still leaning that way. But again, until those long-term support levels that I started the video with go, anything can happen. They've done it before. They've rallied it off these levels both times we hit them earlier in the year. They can do it again. But this time around, the charts do appear different. Back then, I didn't foresee a break of those levels in a waterfall sell-off. I looked for a rally off those levels. This time, I think it's different. So I'm still leaning towards the possibility whether we rally for, this week. And this week, my theme is I think we'll probably just continue to flounder around because of the big earnings. Let's get to those real quick. Let me just talk about those. All right, so what I'm referring to is QQQ, and I'm going to go through the holdings here. Apple, we don't have until next week. That is the largest component of both the S&P and the QQQ, but they don't report until November 1st after the market close. Apple, as I mentioned, sitting on precariously on support, still on support after it broke this wedge here. I give it the benefit of the doubt trend line, which so far is held on a daily closing basis. Those are just intraday spikes below, and that 216-ish level. So Apple, like I laid out a scenario, can certainly push higher if it wants to, run up. Maybe the other components that report this week give it a pop. If they can pop the Qs, and I'm referring to Amazon, Microsoft, Alphabet, and Intel, they all report this week on Wednesday or Thursday. We'll get to those charts in a second, and that's it. So whatever the market's reaction is, I don't even care so much what the earnings, if their earnings beat expectation, if the guidance is better than expected, worse. All that matters is the market's reaction and not the knee-jerk reaction. I always say that. It's the lasting reaction. What happens in the after-hour session after they report can and often does get faded. We saw that recently with Netflix. That was a great example, and I've seen it many, many times again. So I would just caution anyone not to overreact to any initial reaction that happens, even if it's to the downside. Let's let the dust settle the next day and we'll see how the charts pan out this week. So we're probably looking at volatile trading. Anything's possible, but I can't see the markets melting down or running away too hard with all those big components reporting. It's a lot like an FOMC meeting. I always have the same expectation on when there's a big rate hike or an FOMC meeting where there's a rate hike expected. The market tends to go into a holding pattern about a day or two before, very little volatility, maybe some choppy back and forth as people are positioning, but you're not going to see a sharp rally up to an FOMC meeting or a sharp drop down to it. It's usually the fireworks start afterwards. Same thing with a company's earnings report. Now, I've made mention before many times that as we're right now, we're in the thick earnings season. This is probably peak week here, this week and next week. And I usually say, well, at this point in time, that's why I've had a lot of ETF sector and index ETF trade ideas, because you're relatively immune, relatively speaking, to a large gap against your position. If you trade an individual stock, even a mega cap like Apple or Amazon, a double-digit gap against your position is very possible. It's a 10% gain or loss is not very common on a built a trillion-dollar company like Apple or Amazon, but they do happen. And of course, as you go down the spectrum in market cap, meaning the smaller a company is, the larger the potential for a gap is. So again, you roll the dice when you hold a company going into earnings. So I usually say to mitigate that, go with an ETF during earnings season, sector ETF, or even a broad market ETF. However, at this point in time, because we do have, like I said, this week alone, within 2 days, Amazon, Microsoft, Alphabet, and Intel. And I can tell you right now, I did the math. I went to their site. These are updated numbers. Collectively, those four companies make up 32% of the NASDAQ 100. So 1/3 of QQQ is weighted in just those four stocks. And again, that doesn't even include Apple. You throw Apple in there now, and you have close to a 50% weighting. So you are therefore this week. The potential for a pretty big swing in QQQ is there. It all depends. Now, some of these earnings may balance each other out. Amazon may do good. Microsoft does poorly after earnings. They could balance out. But again, it's really more about what the market's reaction is to these. So I just wanted to point that out. And if you're a swing trader, just stick with your trading plan. If you have longs or shorts and you went in for a specific reason, you bought at support or on a trend line break or a breakdown or a breakout to the upside, and your trade's still intact, hasn't hit your stop, hasn't hit your profit targets, you may want to let it ride. But I would also advise against jumping the gun on breakouts, because with this increased volatility, like I just showed you. Again, let's go back to QQQ. Look at this 1 minute chart today. whipsaw city. These are big swings. And what that does is when you have this, program buying from, the algos and HFT driven rips and dips, it tends to take both the indexes themselves as well as a lot of individual stocks and whip them right through support and resistance levels, trend lines. So you're going to have an increased rate of whipsaw signals. So again, the theme here is there'll be a lot of scrambling for positioning. I think I'm leaning towards a down week, slightly down as we head into earnings, because I do think with the recent volatility and the fact that flight to safety assets like gold and treasuries are not providing big gains like they usually do during periods of market volatility. Therefore, it's my theory, it's just a theory, that these big institutions, pension funds, hedge funds, mutual funds will start to reduce risk as we get closer into these companies reporting because they can't afford to be on the wrong side of a gap down. They're so concentrated in the big names, those big FAANG stocks that again, that's what I would do if I were them because the charts are still um, have a lot of damage inflicted. The charts are still bearish, intermediate, longer term. And so the risk, I think, the risk reward is still skewed to the downside. So I can just tell you, but then again, they were the same ones buying up here a few weeks ago. So I can't tell you what the mindset is right now. And what I've read, the majority institutional investors are bullish on the market now. I just read that in Barron's over the weekend, and they think it's going higher. So again, that's the majority. We'll see. Sometimes it's their actions don't match their words. All right, so levels to watch. Last week, if you recall, these are the levels I posted. These blue lines and that 171.50 really being like the last ditch, last line in the sand, so to speak. I hate to use that analogy or that term when you have such sharp volatility, especially with the uncertainty of earnings coming up. But you can see this 172.50, which was originally I had these four blue lines. It is working like a charm to contain all these pullbacks. Look at all these are 30-minute candles. Look at all these 30-minute candle tags, including today. We reversed just a hair shy of it, but you can see that the market is trading off these levels. That green candle popped us up through 174.29, but again, it was on that HFT driven ramp I just showed you. So what is that? That's what I refer to as a momentum fueled overshoot. You had a near vertical ascent. Um, in the Qs, driven by Amazon, a lot of the other stocks. So you popped above support, but look where we are right now, 174.12, meaning that was a momentum fueled overshoot. We overshot it because we had such rapid momentum going into it, fell back, and that's now we're trading as sort of stabilizing, if you will, but just below support. So technically, that's to me, what I'm trying to get at is here's a trading range that we've been in between these two lines since last week. And today, although we overshot it briefly, we snapped back below it, so we're still below it. So these are the levels to watch. And you want to see a solid 30 or 60-minute candle close above it. If so, then there's your next resistance right up there, 175.67. Now we have more taps on the bottom of this level here, around 172.50. And I tried to define the lower end of the range. So that is even more significant right now than this level, which has already been traded through a few times. A break below that level would be quite bearish. Again, I don't know if we get a waterfall sell-off. Anything is possible, but the markets, like I say, may just flounder around, chop around somewhat in this range until we get the earnings out of the way, at least of those big four that I mentioned earlier. All right, let's look at a few more levels and we'll wrap it up here. Here's QQQ on a 15-minute chart. So I'm watching this downtrend line in the Qs. So far, we're just below it. I could probably tighten it up right now. Yeah, let's do that. So we're really challenging that trend line right now. So if you want to replicate this on a 15-minute chart, just make sure you use log scaling, and your chart should look the same there. That trend line comes right out here off that's the early October highs there, and then captures these highs. And those same levels about, here you can see 172.89. You can lower that line down a little bit, call it 172.50 again, because there's a few spikes below. That's what happens when you have volatility. Sometimes you bounce right off the level. Sometimes you go undercut it a little and overshoot it to the downside. But you can see a lot of candles around that area, 172.60 roughly. All right, so there are the levels to watch in the downtrend line. Now let's go through while we're on this 15-minute chart. I want to show you what I'm watching today as well. These 15-minute downtrend lines on the market leading stocks. Remember, As I told you, just Amazon, Microsoft, Alphabet, and Intel are 32% of the QQQ. They make up 32% of the weighting. Apple add another 13%, so now you're at 45% there. So almost half of the returns of QQQ come from just those five stocks. And so here's Apple. Apple took out not the best defined downtrend line, but I see similar downtrend lines on all the top components of the QQQ, and not by coincidence. Again, it all talks to the whole theme I'm talking about. There's a tremendous concentration in those stocks, so it cuts both ways. Money flows into QQQ, great. They all go up. Those five stocks for the most part. Money coming out, it's gonna lead to forced liquidation in these stocks. So QQQ, or Apple, I should say, took out this level here. I have some resistance support levels, but the downtrend line was taken out. We popped right up to here. This is a target I have here, 22.91. A lot of reactions along there. And again, being the largest component, you may want to keep your eyes on this one. And Apple doesn't report to next week, like I said. So there's a level to watch. Bullish if they take it out. We'll call it 223 because you can see some momentum fueled overshoots today. Um, Bearish if it fails, and if it comes back in, supports will be 220 roughly, and then the downtrend line, we can extend that going forward and maybe look for that. So, the point is, I like to watch these collectively. If I see Apple take out that level, the 223 or today's highs, I also see, let's go to the next one, Amazon here, struggling with a comparable downtrend line as I just showed you, popped above it, but not very impulsively and pretty much hugging the trend line. So it was a momentum fueled overshoot on that HFT rip I showed you earlier with Amazon right here on the 1 minute chart. That whoosh, straight up rip. Overshot that level here a little bit on the 15-minute chart, and we're parked on it right now with some resistance there around 1810.61. You can see the reactions that define that resistance level. Here's what the bulls want to see. They want to see those levels, today's highs. Let's keep it very simple. So far, today's highs get taken out. That'll take out that resistance level in Amazon. It'll take out the level I just showed you in Apple. Here's Microsoft, comparable downtrend line, quite a few reactions along the way. Microsoft has a little work to do because if it can pop above the downtrend line, it already failed on the earlier attempt today. It failed last week. Here's all your reactions. That's what makes up that trend line. But it does have horizontal price resistance around 111 to contend with. There's also a little gap there if it can get above that. So there's Microsoft, here's Alphabet, GOOG, and same thing. So here's the story. The common theme is only Apple has taken out the downtrend line, but it ran into horizontal price resistance. All the rest of these top components on QQQ so far that I've gone through, including Alphabet here, are at that downtrend line resistance now. And you can also draw an uptrend line here, and that gives us a little symmetrical triangle, just like we had a symmetrical triangle here. And that's what happens. So if you're an active trader, there's money to be made in these markets. You just have to keep a chart. If you're trading QQQ, keep a chart up, but I would also keep an eye on these. You want additional confirmation of any breakdown on QQQ. You want to see all these big stocks break. So there it is. Keep it that simple. Downside break. I don't want to oversimplify it, but again, you have to look at, if Google breaks down here, in QQQ or the rest of those stocks I just mentioned don't, then that breakdown is likely to prove to be a false breakdown. That's what I'm trying to get at by telling you, the way I like to keep an eye on all of these stocks. And I know it can be a little difficult. And if active trading isn't your thing, then, stand aside. Finally, before I wrap this video up, let's just talk about some bigger picture stuff. Today, I've noticed a very stark outperformance between the S&P 500, currently down 0.39%, and the Nasdaq 100 up 0.55. So you have a better than at one point it was well above a 1% differential between the two today. You don't see that very often. That shows me the FAANG stocks are holding up relatively well. There's relative performance. However, it also tells me there's broad-based selling in the S&P 500. I have right now, and I mentioned this in the trading room today. Let me check right now. I have 1, 2, 3. Looking at the sectors of the S&P 500 off the current chart. Okay, now we have 3 green. A little bit earlier, we had only 2 green. We started the day out shortly after the open. All the S&P 500 sectors at one point were green right after the open. An hour or so later, only 2 were green, with 9 of those being red. There's 11 sectors total. That shows me broad-based selling in the market, and that's not a good sign. Good that the FANGs are holding up today, but and XLK being one of the stronger sectors. But you want to look at what concerns me right now are the financials. Okay, so here we are. We have a rally going on in QQQ. The FANG stocks are usual suspects. Everybody wants to buy Apple. Everybody wants to buy Amazon. Nobody's afraid of their earnings. They think they're going to blow it out of the park. And the earnings are strong. Those companies are earnings juggernauts. It's not about earnings right now or fundamentals. It's about technicals to me. The market looks out 6 to 9 months ahead. And, I've talked about this. How much of those earnings are already priced into the stock or have been over the last year or so? So we'll see what happens. But this is not a good sign. Financials are coming under heavy selling pressure again today. From a technical perspective, they don't look good right now. You have, let me give you another support level right here. See this recent low? You have a reaction right here, some reactions. So they're dancing on support right now. And like the broad markets recently, they just broke down, I should say, from what appears to be a bear flag continuation pattern. There's your impulsive move down, an impulsive breakdown. Yes, it's being foiled somewhat in the Qs today because of those FANG stocks holding up. And again, I think that's all due to earnings. I feel strong that if those companies weren't reporting this week or next, that the bear flag breakdowns last week in QQQ would be following through today to the downside. Again, I think it's people not wanting to short a stock, big company like that, especially when their primary trends are up right for earnings. But what's going on here? That's another story. Why are financials falling so much on a day like today? And remember, these are the mega cap financials. These are your big banks, JP Morgan, Bank of America, Wells Fargo, Citibank. You have Berkshire Hathaway. But then when you look at the regional banks, they've been falling off a cliff. These are your SunTrust, Fifth Third Bank, Huntington Bank, a lot of the regional banks there in KRE, which is a regional banking ETF. And look at this move down so far. They're in free fall now, down 17% off the high. So what's going on with this economy? We see the banking sector really starting to come under pressure. A few weeks ago, all I heard was, oh, the banks are going to do well, the interest rates are going up, that helps the bank's margins. And I commented on that. It doesn't. It did to a point, and it does to a point, but not when interest rates, especially long-term rates, continue to go up because now mortgages are falling off a cliff. We're hitting that magic wall. Interest rates on the 30-year bond and 10-year bond, which affects mortgage rates, are going up. So what happens? What does that mean? New sales, new home sales, and refinancing for banks start shutting down. That's a big part of their profit, and that's also reflected in the not ITA XHB, the home builders. You can see the home builders in a virtual free fall as well. So these are the some of the big key pillars of the economy. The housing market, and of course the banking sector. And XHB is now to support right here, very oversold. So it's not anything I'd look to be shorting right here, but I'm pointing this out more so. What is it telling us right now? What's going on with the market? Why are the home builders crashing? We know home sales are slowing, and again, it's due to those rates. So normally rising rates are good for the banks, but not when all of a sudden we've been in an environment for years now that's used to uber low interest rates, and they just can't take. We're going to hit that ceiling and I think that we've already hit it here. So these are the things I'm watching. Again, that just paints a bigger picture on the broad market. Forget about technology for a second, although that is holding us up today. That is XLK is almost single-handedly boosting the markets today, up 1%. And again, you have the S&P about down, 5%. And this is also one of the largest sectors in the S&P. So that goes to show you that these, big gains today in the tech stocks, everybody buying them in front of their earnings, are being overshadowed by the losses in financials and most of the majority of the other sectors. All right, so we'll wrap it up here. I believe I covered all the levels I wanted to show you to watch. And there's SPY. I should have covered that for you guys. Here's one thing that was pointed out last night. I'd point out in the trading room, and someone else mentioned it too. There were divergences on the futures. This is a 15-minute chart only. We don't have them on the 60-minute yet, but there's divergent low right there. That's something to watch on the S&P 500. If you're looking to go long, again, this week you could get chopped to pieces with the earnings. It could work for you or against you, but there's some potential divergences. We'll see if that plays out. On QQQ, we had them on the futures as well. There's your divergence right there. Although we really haven't made a lower low, we're just making equal lows, but that's still positive divergence so far on the 15-minute chart, and doesn't mean we have to play out those divergences have to play out for a bounce. And again, we do not have it here on the 60. This is where I get interested in going long when I see divergences, and I think I've laid out this scenario now for at least a week, and that would be no matter what happens this week, choppy or not, another thrust down here, come in, put in 60-minute divergent lows, hit some of my downside targets on QQQ and some other things, and then that's where I'll look to start looking to go long. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.